So you've made the decision to begin investing. You're already aware that a low PE ratio is generally preferable to a high PE ratio, and that a company with a lot of cash on its balance sheet is preferable to one with a lot of debt. Analyst recommendations should always be taken with a grain of salt. And you know the smart investor's cardinal rule: a portfolio should be diversified across multiple sectors. Whether or not you've waded through the more complicated concepts of technical analysis covers the basics, you are now prepared to select stocks. But hold on, how do you pick a few worth purchasing with tens of thousands of stocks to choose from? Today, we are showing you some steps to follow to find a suitable stock for yourself. And if you enjoy such content, make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin. Firstly, determine your goals. The first step in selecting investments is to determine the goal of your portfolio. Of course, everyone wants to make money when they invest, but investors may be more concerned with generating an income supplement during retirement, preserving their wealth, or capital appreciation. Each of these objectives necessitates a distinct strategy. For that, understand the type of investors. There are three types of investors. Income investors prefer to invest in companies that pay out regular dividends. These are typically solid but low-growth companies in industries such as utilities, highly rated bonds, real estate investment trusts, and master limited partnerships are options. Investors who seek to preserve their wealth have a low risk tolerance, either by nature or due to their circumstances. They prefer to invest in well-established blue-chip companies. They may focus on consumer staples, companies that thrive in both good and bad times. They are not interested in initial public offerings. Investors seeking capital appreciation are looking for stocks of companies in their best early growth years. They are willing to take on more risk in exchange for the possibility of large profits. Always be aware. It is critical to stay current on market news and opinions. Passive research includes reading financial news and keeping up with the industry blogs written by writers whose perspective you value. An investment thesis can be built based on a news article or a blog post. The underlying argument could be a simple observation. For example, you might notice that emerging market countries are creating new middle classes of people who want a wider range of consumer goods. As a result, demand for certain products and commodities will increase. Don't forget to make a diversified portfolio. Any of these investor types could employ a combination of strategies. In fact, this is one of the primary reasons for diversification. For example, a conservative investor can allocate a small percentage of his or her portfolio to growth stocks. On the other hand, a more aggressive investor should set aside a percentage for solid blue-chip stocks to offset losses. The easy part is determining which category you belong to. After that, choosing which stocks to buy becomes difficult. If you use a stock screener, it is prone to error. Riding institutional investors' coattails is an option, but you should be aware that they tend to favor safe blue-chip stocks that may or may not provide the best returns. Analyze the nature and outlook of business. Examine the true nature of the business, as well as the company's past financial track record, to determine whether the current policies and projects are value generators for the future. The final investment decision is based on the current state of the industry. Also, don't chase stocks that have delivered multi-bagger returns in a short period. Before proceeding, conduct thorough research. Experts believe that many first-time investors lose money by chasing stocks that have already risen several folds in a year or two. In those cases, they need to check and ensure the valuation multiple is still attractive and not an outlier compared with its own past or peers' current valuation multiples. Don't forget to check profitability or analyze potential investments with statistics. Once a theme has been established, it is necessary to narrow down the potential universe of stocks. Many investors prefer to invest in companies of a certain size. A common measure of a company size is market capitalization, which is calculated by multiplying the number of outstanding shares by the current stock price. Firms are classified as micro, small, mid, or large capitalization based on the outstanding value of their stock. Most investors are familiar with well-known large-cap companies such as Apple, Amazon.com, and ExxonMobil. However, some themes concentrate on more obscure market segments in which only smaller companies participate, such as ethanol or modular rental companies. Investors can review company characteristics, such as growth prospects, after narrowing the potential list of companies by market capitalization. For example, investors generally expect very high growth in sales, earnings, or other relevant numbers when a company or industry is in the early stages of the business or product life cycle. more mature companies are expected to grow at a slower but steadily increasing rate. Dividend payments are also affected by growth. Younger or high-growth companies typically reinvest free cash flows into the business, whereas more mature companies may pay above-average dividends with cash flow. Other screen components focus on a company's financial position via financial ratios such as liquidity, debt, and profitability ratios. In general, liquidity ratios assess a company's cash and short-term asset position about its short-term liabilities, as well as its ability to meet its short-term obligations, particularly working capital. Debt ratios examine a company's ability to service its debt obligations, as well as the size of its debts in relation to its equity or assets. Finally, profitability ratios show the return on assets employed, dollars invested, or equity held. Another screen includes stock valuation parameters, which assist investors in determining whether a stock price is appealing in relation to the company's earnings, assets, book value, and other characteristics. For example, price to earnings, price to sales, price to book, and enterprise value to earnings before interest, taxes, depreciation, and amortization are all common valuation multiples. Also, follow the valuation method. It's easy to become overwhelmed by the number of valuation techniques available to investors when deciding which valuation method to use to value a stock for the first time. Some valuation methods are fairly simple, while others are more involved and complicated. Unfortunately, no single method is best suited for every situation. Each stock is unique, and each industry or sector has distinct characteristics that may necessitate the use of multiple valuation methods. Keep watching the video further to look at the most common valuation methods and when they are appropriate to use. How to choose the best stock valuation method? There are two types of valuation models and two types of valuation methods, absolute and relative. First is absolute valuing. Absolute valuation models seek to determine an investment's intrinsic or true value based solely on fundamentals. Looking at fundamentals simply means focusing on a single company's dividends, cash flow, and growth rate while disregarding all other companies. This category includes valuation models such as the dividend discount model, discounted cash flow model, residual income model, and asset-based model. Next is relative pricing. Relative valuation models, on the other hand, work by comparing the company under consideration to other similar companies. These methods entail calculating multiples and ratios, such as the price-to-earnings ratio, and comparing them to similar companies' multiples. For example, if a company's PE ratio is lower than that of a comparable company, the original company may be considered undervalued, because the relative valuation model is much easier and faster to calculate than the absolute valuation model. Many investors and analysts begin their analysis with it. Let's look at some of the more popular valuation methods available to investors and see when each model is appropriate to use. Discounted cash flow model, DCF. What if the company does not pay a dividend or has an irregular dividend pattern? In this case, proceed to determine whether the company meets the criteria for using the discounted cash flow model. Instead of dividends, the DCF model values a company based on its discounted future cash flows. The main advantage of this method is that it can be applied to a wide range of companies that do not pay dividends, as well as companies that do pay dividends, such as company XYZ in the previous example. The DCF model comes in several flavors, but the most common is the two-stage DCF model. This variant forecasts free cash flows for 5 to 10 years. Then a terminal value is calculated to account for all cash flows that occur after the forecasted period. The company must first have a positive and predictable free cash flows in order to use this model. Due to the large capital expenditures that these companies typically face, many small, high-growth, and non-mature firms will be excluded based solely on this requirement. Dividend discount model, DDM. One of the most fundamental absolute valuation models is the dividend discount model. The dividend discount model determines a company's true value based on the dividends paid to its shareholders. The justification for using dividends to value a company is that dividends represent actual cash flows to shareholders. So valuing the present value of these cash flows should give you an idea of how much the share should be worth. The first step is to determine whether or not the company pays dividends. The second step is determining whether the dividend is stable and predictable, because simply paying a dividend is not enough. Companies that pay consistent and predictable dividends are typically mature, blue-chip firms in well-developed industries. As a result, these companies are frequently the best candidates for the DDM valuation model. What do you think of these methods? Let us know your views in the comments below.